Hey everyone, welcome back to Corporate Decoder. Today LOKVU just filed an 8K about a shareholder meeting, and I'm seeing a few key outcomes that matter for investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just held a big meeting where shareholders voted on several important proposals, and the results show strong approval for the company's path forward. So what happened here is Oak Acquisition Corp V, which is a special kind of company called a SPAC, or a blank check company, held its shareholder meeting on the 16th of June 2026. These meetings are where shareholders get to vote on major company decisions, and today we are looking at the results of those votes. Oak Acquisition Corp V is actually listed on the Nasdaq under the ticker LOKVU for its units, LOK for its shares, and LOKVU for its warrants. It is a company that was formed to acquire another business. Think of it like a placeholder company that goes out and finds a good company to merge with. This filing is all about the votes that happened. Shareholders were asked to approve a bunch of things, and we can see the detailed breakdown of how everyone voted. The meeting date was the 16th of June 2026, and the shareholders who were on record as of May 7, 2026 were the ones who got to cast their votes. There were about 28.75 million shares outstanding at that time. The first major vote was on the business combination proposal. This is essentially the vote to approve the main deal the company has been working towards, which is merging with or acquiring another business. Shareholders overwhelmingly approved this, with over 20 million votes in favour. Next up was the Domestication proposal. This usually means changing the company's legal home, perhaps moving it to a different country or state to simplify things or for tax reasons. Live Oak shareholders also approved this one with the same strong majority. Then came the charter proposal. This is about amending the company's fundamental rules. Its charter. Again, this passed with a large number of votes in favour. Proposals 4 through 9 dealt with the company's organisational documents, basically refining the rules of how the company operates. Proposal 4 specifically addressed the authorized share capital, meaning how many shares the company can issue. This was approved though with a slightly larger number of against votes compared to the first few proposals. Proposal 5, the exclusive forum proposal, addresses where legal disputes could be brought. This also passed. Proposal 6 was another charter amendment which passed. Proposal 7 was about director removal, and this also received approval from the shareholders. Proposal 8, the call for shareholder meeting, was also approved. Proposal 9 involved provisions related to the company's status as a blank check company and a potential name change. This proposal also garnered strong support. Following these, we have Proposal 10, the incentive plan proposal. This is about granting stock options or other incentives to employees and management, which is pretty standard for companies. This passed as well, though again with a noticeable number of opposing votes. Proposal 11 was the employee stock purchase plan proposal. This allows employees to buy company stock, often at a discount. This too was approved. Proposal 12 was the Nasdaq proposal, likely related to maintaining its listing on the Nasdaq exchange. This passed with the strong majority we saw earlier. Then we have Proposal 13 involving the election of directors. The names listed are Michael Brown, Alex EU, Adam J. Fishman, Richard J. Hendricks, and Evan Moore. All of them were elected with a significant number of votes in favour for each. This shows the shareholders have confidence in the current leadership team to guide the company. Finally, Proposal 14 was the insider letter amendment proposal. Insider letters are agreements that early investors or founders sign, and amendments suggest changes to those original terms. This was also approved by shareholders. Now this next part is really important and tells us a lot about investor sentiment. A significant number of shareholders, almost 18.5 million shares, decided to redeem their shares. This means they chose to get their money back from the company's trust account instead of staying invested in the company after the merger. When shareholders redeem, it means they are cashing out. Probably because they are not confident in the deal or want to lock in their initial investment. Because so many shareholders cashed out, the amount of money left in the trust account, which is essentially the company's war chest for the acquisition, has dropped to about $48.1 million. This is a pretty substantial reduction from what it might have been initially. For context, SPACs often tried to raise hundreds of millions of dollars in their IPO. This means much of the capital raised has been returned to investors, which can signal caution from the market about the remaining deal. Following the meeting on the 16th of June 2026, Live Oak announced that the shareholders had indeed voted to approve the business combination and other related proposals. This announcement is part of the official record. D. Exhibits. The filing also lists exhibits, which are supplementary documents. The most important one here is Exhibit 99.1, which is the press release detailing these announcements and voting results. And as usual, the filing is signed by the company's leadership, in this case Richard Hendricks, the Chief Executive Officer, signed off on the 18th of June 2026. So what is the big picture here? Oak Acquisition Corp V's shareholders have clearly approved the path forward with the business combination. However, the large number of redemptions leading to a significant drawdown in the trust account suggests that a considerable portion of investors were not fully on board with the deal or were happy to take their money back. The remaining $48.1 million may be substantial for some companies, but for a SPAC aiming for a significant merger, it could be a limiting factor. It really makes you wonder if the target company is still as attractive, or if Live Oak will have to finance a larger portion of the deal themselves. My biggest concern is that the high redemption rate might reflect a lack of confidence in the future value of the combined entity, or perhaps a strategic decision by many investors to exit while they could still recoup their initial investment. This is a common pattern for SPACs where investor enthusiasm wanes post merger announcement, particularly if the SPAC does not find a truly compelling target or if market conditions shift unfavorably. We will need to watch closely how this $48.1 million war chest is used and what the combined company's strategy will be to generate future value. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.